First one is technical analysis. Technical analysis is a method of evaluating securities by analyzing historical price movements and trading volume with the aim of forecasting future price action. This approach does not concern itself with the intrinsic value of an asset, but rather focuses on identifying patterns and trends based on market behavior. Technical analysts believe that all the necessary information about a stock's value is already reflected in its price. So the key to making profitable decisions lies in understanding market psychology and historical price patterns. How does it work? Technical analysis assumes that prices move in trends and that historical price action tends to repeat itself. This assumption is based on the idea that investor behavior often follows certain predictable patterns due to psychological factors, such as fear, greed, and market sentiment. Key elements of technical analysis. Charts and patterns. Technical analysts primarily use price charts to study historical movements of an asset. The most commonly used charts include candlestick charts. Provide a detailed view of price movements over specific time frames, showing the open, high, low, and close prices for each period. Line charts. Simpler charts that show the closing prices over time. Bar charts, similar to candlestick charts, but use bars to show the range between high and low prices. Analysts look for specific patterns in these charts that indicate future price direction. These include head and shoulders, a reversal pattern that suggests the price is likely to change direction. Double top, double bottom, patterns that indicate potential changes in trend, either upward or downward. Triangles, ascending, descending, symmetrical. These patterns can indicate continuation or reversal of the trend. Flags and pennants, short-term continuation patterns that often occur after a sharp price movement. Support and resistance. Support levels refer to price points where the stock has historically bounced upward after a decline. These are seen as floors, where buying interest is strong enough to prevent further price drops. Resistance levels are the opposite. They are price points where the stock has historically faced selling pressure and struggled to rise above. These are viewed as ceilings for the stock price. When a price breaks through either support or resistance, it often signals a new trend. For example, breaking above a resistance level can suggest a bullish trend, while falling below support may indicate a bearish trend. Indicators and oscillators. Technical analysts use various mathematical indicators to confirm trends or identify overbought or oversold conditions. Some key indicators include moving averages, MA. These smooth out price data to identify trends over different time frames, e.g. 50-day or 200-day moving averages. A common signal is when a short-term moving average crosses above or below a long-term one. Relative Strength Index, RSI, measures the speed and change of price movements, giving insights into whether a stock is overbought or oversold. RSI values above 70 indicate overbought conditions, while values below 30 suggest oversold conditions. MACD, moving average divergence, shows the relationship between moving averages, helping to identify changes in momentum and potential trend reversals. Trend lines. Trend lines are drawn to connect either the highs or lows on a price chart, providing a visual representation of the stock's direction. Upward trend lines are drawn through higher lows, signaling a bullish trend, while downward trend lines are drawn through lower highs, indicating a bearish trend. Analysts also use channels, which are parallel lines that contain price movement within a defined range, helping to identify when a stock is about to break out or break down. Technical analysis in practice. Traders using technical analysis often combine multiple indicators and patterns to improve the accuracy of their predictions. Day traders and swing traders frequently use this method to make quick, short-term decisions, taking advantage of small price fluctuations in the market. Advantages and disadvantages of technical analysis. Advantages. Provides clear entry and exit points based on historical price action. Useful for short-term traders who need to make quick decisions. Can be applied to any market, stocks, forex, cryptocurrencies, etc. Disadvantages. It ignores the fundamental value of a security. meaning it does not consider the financial health or future prospects of a company. Patterns are not always reliable and can be subjective, depending on how they are interpreted. It can be ineffective in highly volatile or unpredictable markets driven by news or events. Second one are fundamental analysis. In contrast to technical analysis, fundamental analysis is concerned with evaluating the intrinsic value of an asset. Investors using this method look at a company's financial health, its business model, industry position, and the broader economic environment to determine whether the stock is undervalued or overvalued. The idea is that, over time, the market will accurately reflect the true value of a company, and by buying undervalued assets, investors can earn profits as the stock price rises to match its intrinsic value. Key elements of fundamental analysis. Financial statements. Fundamental analysts rely on a company's financial documents to understand its profitability, liquidity, and overall health. The three main financial statements analyzed are: income statement, shows the company's revenue, expenses, and profit over a specific period. It helps investors assess whether a company is profitable. Balance sheet summarizes the company's assets, liabilities, and shareholders' equity at a given point in time. It provides a snapshot of the company's financial strength. Cash flow statement shows the company's inflows and outflows of cash, giving insight into its liquidity and how well it can meet short-term obligations. Key ratios. PE ratio, price to earnings ratio. This ratio compares a company's stock price to its earnings per share, EPS. A lower PE ratio may indicate that a stock is undervalued, while a higher ratio could mean it's overvalued. PB ratio, price to book ratio, compares the market price of the stock to the company's book value, assets minus liabilities. A lower PB ratio suggests the stock is trading below its book value, potentially indicating an undervalued asset. Dividend yield. This measures the annual dividend payments relative to the stock price. High dividend yields may be attractive to income-seeking investors. Qualitative factors. Management. The quality and experience of the company's leadership team can have a big impact on its long-term success. Industry and competition. Understanding the competitive landscape and the company's position within its industry can reveal its potential for growth. Economic environment. Broader macroeconomic factors, such as interest rates, inflation, and consumer demand, play a significant role in determining a company's future performance. Macroeconomic factors, interest rates, inflation, and unemployment rates are just a few examples of economic indicators that can influence a company's prospects. For example, in a rising interest rate environment, companies that rely heavily on borrowing may see their profits shrink due to higher debt servicing costs. Fundamental analysis in practice. Fundamental analysis is most often used by long-term investors like Warren Buffett, who look to buy stocks in companies with strong financials and growth potential. The goal is to hold these stocks for an extended period, allowing time for the market to recognize the company's true value. Advantages and disadvantages of fundamental analysis. Advantages: provides a deep understanding of the company's actual value and long-term prospects. Helps investors identify companies that are undervalued by the market, offering opportunities for significant gains. Takes a holistic approach by considering both qualitative and quantitative factors. Disadvantages: time-consuming, requiring detailed analysis of financial reports and broader market conditions. May not be useful for short-term trading, as stock prices can be influenced by factors that have little to do with the company's intrinsic value. Can be less effective in unpredictable markets, where news or macroeconomic factors drive stock prices more than fundamentals. Comparison of technical and fundamental analysis. Technical analysis is typically used by short-term traders who are looking for patterns and trends in the price movement to make quick decisions. It is most effective in liquid markets where prices move freely, such as stocks, forex, and cryptocurrencies. Fundamental analysis, on the other hand, is favored by long-term investors who are more interested in understanding the true value of a company and its potential for growth. It involves deep analysis of a company's financials, management, and the economic environment.